Imagine waking up tomorrow and every minute of your day is completely yours. No boss, no deadlines, just pure freedom. What would you actually do? Picture the silence after years of rushing. This isn't a fantasy, it's a future you can build, and it starts with understanding your freedom number. Are you ready to discover the precise financial blueprint that unlocks a life lived entirely on your terms? Stop trading your most precious asset, time, for money you'll barely enjoy. Time is the one thing you cannot refund. If you feel it slipping, this is your wake-up call. Most people spend their lives chasing a paycheck. But what if there was a strategic number that could liberate you from the 9-to-5 treadmill forever? That number is not luck. This video reveals the Freedom Number Blueprint, giving you the practical steps to reclaim your time and design a life where every moment is a choice, not an obligation. Starting today, right now. Feeling trapped by your current routine, constantly wishing for more time and less stress, you're not alone. Many dream of financial independence, but few know the exact mathematical target that makes it a reality. In this video, I'm breaking down the Freedom Number, the personalized financial goal that, once achieved, gives you back complete control over your time and ultimately your life's direction. Stay with me. I'm Dave, and we're going to turn that target into a plan you can run on autopilot. By the end, you'll have your freedom number, a dividend strategy, and clear steps to start this week. We'll define your lifestyle cost, convert it into an annual income goal, translate that into a portfolio size, then build the income stream with dividends, reinvestment, and risk control. Without guessing or hype, most people underestimate expenses because they only count bills. Freedom requires counting the life you want: health, movement, learning, experiences, and the things that remove daily friction from your schedule. Start with 3 tiers: survival, comfortable, and ideal. Survival is your minimum with zero panic. Comfortable is the life you'd happily repeat. Ideal is the life that makes you grateful. It's Tuesday, right? Survival costs first: housing, food, utilities, transport, insurance, and debt minimums. Be honest, not optimistic. A freedom number built on wishful thinking collapses the first time reality hits. Now add comfortable upgrades, better groceries, occasional dining out, hobbies, gifts, and a little travel. This is where your life starts feeling like yours, not like a holding pattern. Then add ideal costs: bigger travel, passion projects, family support, charitable giving, and services that buy time back. Maybe it's cleaning help, meal prep, childcare support, or a personal trainer. Next, add a buffer, because inflation exists and life is messy. 10% is a starting point, but your buffer should match your responsibilities, your health, and your risk tolerance. If your costs are $5,000 per month, a 10% buffer makes it $5,500. If your costs are $8,000, a buffer makes it $8,800. Simple, but powerful. Now separate needs from wants without guilt. Wants are not the enemy. Unplanned wants are the enemy. Planned wants are exactly what freedom is for, and your number should reflect that. Your freedom number begins as monthly freedom income. That is the income that pays your entire lifestyle, plus buffer, without you trading hours for dollars. It's your monthly finish line. Convert monthly income to annual income by multiplying by 12. $5,500 monthly becomes $66,000 annually. $8,800 becomes $105,600 annually. Keep this annual number visible. This is the target your portfolio must produce. Not someday, not maybe, but reliably. When the market is boring, this number keeps your actions focused. Now build a reality check by tracking your spending for 30 days. If you can, track for 90 days. A freedom number based on real spending is calmer and more accurate than memory. If tracking feels overwhelming, start with categories: housing, food, transport, health, subscriptions, fun, travel, and random. Most leaks hide in random. Finding them is not shameful, it is liberating. When you finish, choose one tier as your first freedom number. I recommend comfortable, not survival. Survival freedom is fragile. Comfortable freedom lets you enjoy time without constantly guarding every dollar. Finally, choose a timeline. A freedom number without a timeline becomes a daydream. Pick a date range, like 7 years, 10 years, or 15 years, and we will reverse engineer it later. At this point, you have the most important input, your freedom income. Next, we convert income into capital. This is where the blueprint becomes a map you can follow step by step. Before we do, remember this: your first freedom number is not permanent. It can grow as your skills grow. The point is to create a target you can actually hit. Okay, income is set. Let's translate that income into the portfolio size that can pay it. This is the line where dreaming turns into engineering, and engineering creates confidence. There are two ways to fund freedom: selling assets or earning cash flow from assets. Dividends are attractive because you can receive income without shrinking your share count while still allowing growth. To connect income to capital, we use a simple relationship. Annual income equals portfolio value times dividend yield. Rearranged portfolio value equals annual income divided by yield. That's the core blueprint. Yield is the percentage of your portfolio paid out each year as dividends. A 3% yield means $3 per year for every $100 invested. Before taxes and before inflation adjustments, let's do a clean example. Suppose your annual freedom income is $66,000. At a 3% yield, your target portfolio is $66,000 divided by 0.03. That equals $2,200,000. Not because it's magic, but because the math says so. If you want $66,000 per year at 3%, you need about $2.2 million. Now change the yield assumption at 4%. 66,000 divided by 0.04 equals $1,650,000. At 5%, it's $1,320,000. Notice what happened. A higher yield reduces the capital needed, but it can increase risk if the yield comes from fragile businesses or unsustainable payouts. The best plan balances yield and durability. So I like to run 3 scenarios: conservative yield, moderate yield, and aggressive yield. Conservative might be 3% with strong growth. Moderate might be 4% with quality. Aggressive might be 5% carefully. Now try a bigger lifestyle. If your annual freedom income is $105,600, at a 3% yield you need about $3.52 million. At 4%, you need about $2.64 million. These numbers can feel heavy, but they are also clarifying. Once you see the target, you stop wasting time on random moves, and you start building with intention. Next, add inflation awareness. If your costs rise over time, your freedom income must rise too. That means you need dividend growth, not just dividends. The portfolio must increase its payments over years. This is why the blueprint is not chasing the highest yield today. It's building an income engine that grows. Dividend growth is how your freedom number stays relevant when everything costs more. Now you can write your freedom number in one sentence: my freedom. Number is the portfolio size that can generate my annual freedom income at a sustainable yield, with dividend growth protecting purchasing power. That sentence is long, but the idea is simple. Income goal plus yield assumption equals capital target. Then dividend growth plus discipline keeps it alive. Now we build the stream that makes it real. Dividends are simply companies sharing profits with owners. When you own shares, you are an owner. Some companies reinvest all profits, others pay part out, and many do both, especially mature businesses. The mistake beginners make is thinking dividends are free money. They are not free, but they are powerful. Dividends are a transfer of value from a business to you, and they reward patience. Another mistake is chasing yield like it's a scoreboard. A huge yield can be a warning sign. Sometimes the stock price is falling because the business is weakening, and the dividend may get cut. So the goal is reliability first, then growth. You want businesses that can pay through cycles, then raise payouts over time. Stability protects your freedom plan when headlines are loud. Here are practical filters I like: consistent dividend history, reasonable payout ratio, strong cash flow, durable demand, and a culture of shareholder returns. None of these require genius, just discipline. Also, diversify your sources of dividends. If all your income comes from one sector, one regulation change, one commodity shock, or one recession can hit you too hard, diversification is income insurance. You can diversify by sector, by business model, and by geography. Consumer staples, healthcare, utilities, industrials, finance, and technology can all contribute as long as the dividends are supported by real earnings. Now, do you need to pick individual stocks to use this blueprint? No. Many people start with dividend-focused funds or broad market funds that pay dividends. The blueprint works either way. Funds can reduce single company risk and simplify the process. Individual stocks can offer more control and sometimes better income growth. The right choice is the one you can stick with for a decade. Whichever path you choose, focus on 3 outcomes: a rising income stream, a resilient portfolio, and a process you can repeat. Freedom comes from repeatable behaviors more than brilliant predictions. Let's talk about the engine reinvestment. Early on, you do not live on dividends. You reinvest them to buy more shares, which increases the next dividend payment automatically. This is compounding you can feel. Your dividends buy shares, those shares create more dividends. Over time, the growth becomes noticeable, then it becomes undeniable. This is why consistency beats intensity. To make compounding work, you need time and regular contributions. Even modest contributions matter when they are steady. A small stream becomes a river when you keep feeding it and you keep waiting. Now I'll give you a simple framework: core, growth, and stabilizers. Core holdings are diversified dividend payers. Growth holdings increase future income faster. Stabilizers reduce volatility and protect your behavior. Core might be dividend ETFs or a basket of quality dividend growers. Growth might be broad market exposure or dividend growth companies. Stabilizers might be cash reserves and defensive sectors. This framework matters because volatility is not just a chart, it's a test of your habits. If your plan collapses during drawdowns, the math never gets to work. Stability protects your psychology. Another key: your yield today is not your yield forever. Dividend growth raises your yield on cost over time. A stock yielding 3% today can pay 6% on your original cost later. That is the quiet superpower of dividend growth. It turns today's number into tomorrow's freedom, and it reduces your need to chase high yields. Now you let time and growth do the heavy lifting. Now, how do you pick candidates? Start with businesses you understand that sell necessities or sticky services, then confirm the financials, support the dividend. Then, by gradually, not all at once, gradual buying protects you from bad timing. No one buys the exact bottom, but consistent buying across months and years lowers your average cost and reduces regret. Regret is expensive. Finally, remember taxes and accounts matter, but they do not change the blueprint. If taxes reduce your net yield, you adjust the yield assumption. The principle is the same. Net income covers life. Okay, we have the dividend philosophy. Next, we build the empire with a step-by-step system you can run on autopilot. This is where your freedom number stops being theoretical. Step 1 is automation. If you rely on motivation, you will quit when life gets busy. Set a recurring transfer, even if small. Become the kind of person who invests every week. Pick a cadence that fits your paycheck: weekly, bi-weekly, or monthly. Frequency matters less than consistency. Consistency turns investing into a bill you gladly pay because it buys back your future time. Step 2 is a simple starting allocation. Avoid complexity at the beginning. A clean core fund plus a dividend growth tilt is enough. You can refine later. Early complexity is often procrastination wearing a suit. Step 3 is milestone tracking. Create small wins. First $100 in dividends per year, then $500, then $1,000. The numbers are less important than the feeling of progress. When you hit your first meaningful milestone, celebrate responsibly. Not by spending big, but by noticing that your money is starting to work without your permission. That is the beginning of ownership. Step 4 is reinvestment by default. Turn on dividend reinvestment or manually reinvest on a schedule. Early on, your dividends are workers. You do not take them home, you send them back to work. Step 5 is contribution growth. Each time your income rises, raise your investing amount before your lifestyle inflates. Even a 1% increase per raise compounds into years saved on your timeline. Step 6 is protecting the plan with a cash buffer. A cash buffer keeps you from selling investments when life happens. It protects your share count, which protects your future dividend checks. Think of cash as shock absorbers, not as a growth engine. The goal is not to maximize cash returns. The goal is to prevent you from breaking the compounding machine during emergencies. Step 7 is diversification upgrades. As the portfolio grows, expand across sectors and styles. You do not need dozens of holdings. You need enough that one company or one sector cannot control your future. Step 8 is review cadence. Monthly reviews can be too emotional. Quarterly is often better. Check contributions, dividend growth, and allocation drift. Then make small adjustments, not dramatic swings. Step 9 is behavior rules for ugly markets. Decide now what you will do when prices drop 20%. My rule is simple. Keep contributing, reinvest dividends, and avoid checking the account daily. Ugly markets are where freedom is purchased at a discount. When you buy during fear, you are literally buying future income cheaper. That is not comfortable, but it is effective. Step 10 is income math updates. Once per year, recalculate your freedom number based on updated spending and inflation. If your target rises, good, you are learning. You adjust the plan, not abandon it. Now we add timeline engineering. If your capital target is $2,200,000 and you can invest $2,000 per month, we can estimate the journey using conservative return assumptions. The point of a timeline is not precision, it is direction. When you can see the gap, you can choose whether to increase contributions, extend time, or reduce the required lifestyle cost. At this stage, your empire is not built by one big move. It is built by hundreds of small decisions that all point in the same direction. That direction is ownership of your time. Let's talk about the life on the other side, because numbers without vision feel empty. When time is yours, you can sleep well, move slowly, and choose your days intentionally, not reactively. Some people travel. Some build businesses. Some volunteer. Some finally get healthy. Some become present parents. The point is not the activity. The point is the ability to choose without fear. But freedom brings new questions. What if inflation spikes? What if the market crashes? What if dividends get cut? These are reasonable fears, and the blueprint includes defenses for all of them. Inflation defense is dividend growth plus a buffer. If your portfolio's income grows faster than prices over long periods, your purchasing power survives. If you also keep margin, you breathe easier. Market crash defense is time, diversification, and not selling. Dividends can be reduced, but quality businesses often continue paying. Even when payouts pause, your contributions buy more shares cheaply. Dividend cut defense is not concentrating your income in fragile names. Use payout ratios, cash flow trends, and diversification. If one holding cuts, it hurts, but it does not end the plan. Sequence risk defense is flexibility. You can lower spending temporarily, pause travel, or use a cash buffer. Freedom is not perfection. Freedom is having options when conditions are not ideal. Also remember that your identity cannot be only your portfolio. Build hobbies, relationships, skills, and community while you build money. That way, when freedom arrives, you know what to do with it. That is why this blueprint matters. It is not just about retiring early. It is about reclaiming time progressively and making your life bigger every year as your financial engine grows. Now, let's bring it all together. Define your lifestyle cost, add a buffer, and lock in your monthly freedom income. Multiply by 12 to get the annual target that your portfolio must reliably produce. Then choose a sustainable yield assumption, not an exciting one. Divide your annual target by that yield to get your capital goal. That number is not intimidating anymore because it is measurable and actionable. Next, build the dividend engine with quality, diversification, and reinvestment. Automate contributions, grow them over time, and let compounding do what it does best. When you stop interrupting it, here's your action today. Comment your monthly freedom income and the yield you want to assume, and I'll know you actually did the blueprint. Then subscribe and keep building with us step by step.